Okay, you have already submitted your last homework assignment of the semester? Yeah, right? It was this morning at 8. So the last thing on your checklist for the semester is our final exam, and that's a week from today. And it starts at 8 o'clock in this classroom. Like our previous exams, there's going to be both concept questions and some problem-solving questions. And it's going to be about 35% of the points will come from conceptual questions, and about 65% of the points will come from problem solving. So both are important, but there's going to be added weight on the problem solving. The exam is comprehensive, but there's going to be an emphasis on the material that we've covered since the second midterm exam. So you can expect a question from any time in the semester, but more of the points are going to be drawn from the material you haven't been examined on yet. You will need to use Excel for at least one of the problems, and so you're free to use the computers here in the classroom, or you can bring a laptop computer. As before, when you use Excel for a problem, you have to start with a blank workbook. You can't refer to a previously solved homework assignment or in-class exercise. You have to start completely from scratch. Now what you can do is you can bring in a page of notes. Actually, I've decided that you can bring in 2 pages of notes. So if you have maybe your notes handout from a previous exam, you could keep that and then also make a new one on top of it. And it can be front and back of both pages. And so if you're thinking, how are you going to remember to do a certain procedure like external rate of return or incremental analysis, you can remember just as a reminder to yourself how to solve problems like that. One good strategy is to list what the column titles should be for a certain problem type. And just remembering what's supposed to go in each column kind of gives you a guide for which formulas should be used and what's the process and the procedure. And you know, in all of the exams we've had so far, an important point of getting the answer is remembering and being able to apply the decision criteria. So it's not just calculating, but it's then once you've done the calculations, how do you know what to do? Whether to accept or reject the project, or if there's multiple alternatives, being able to interpret which of those alternatives is best from the calculations that you've completed. So please pay special attention to that as you review your notes and prepare for the test, that the decision criteria is a really important part of applying the information from this course. Now I'm going to provide factor tables and these time value equations, but anything that isn't a factor table or this that you think you might need during the exam, you need to put on the page of notes that you bring. And those notes can only be used on part 2, which is the problem solving. They can't be used on the concept questions. The concept questions have to be just based on your understanding of the terminology and the concepts from the course, so you can't just write a bunch of definitions on your paper and then copy those down for part 1. So you've got 7 days to prepare for the test, and my suggestion is a good approach is to look through both your previous homeworks and also, if you haven't already, look at the solutions that are posted online, because for each of the homework assignments my solution is on there, and so if you got a problem wrong, then you definitely want to see what was the difference between how you thought the problem should be solved and what's the actual solution for any given problem. So those are available online, so review the homework problems, look over the in-class exercises. If you have spreadsheet files, refamiliarize yourself with the mechanics of how do you set up a solution for a certain problem. Of course, it's a good idea to read the textbook, but in 7 days it would maybe be tough to do the entire textbook, but just skimming through the sections that we've covered in the book. And if you're really a glutton for punishment, then the videos are available online and you can review certain things. Maybe the selective use of that is the way to go. You know, if there's a certain spreadsheet you don't remember how to solve, then all of the spreadsheet techniques are recorded during our class lectures. So are there any questions about the final exam? Okay, today we're going to be talking about taxes. We were going to do the outcome survey, but I think we'll do that on the day of the exam. It's basically just a list of our course outcomes and you're saying, I feel like I learned it versus I'm not sure if I learned it. So we don't necessarily have to do that today. We'll put it off for a bit later. Today we're talking about taxes, and there's lots of different types of taxes. But before we get into the calculations and how the money is raised, why do you suppose we have to pay taxes? What's the purpose? Yeah.
Some taxes are used to go to the government to help fund different projects. Like I know, like the gas tax goes to infrastructure most of the time.
Right. Yeah, good point. There's some taxes that go to a specific use, like the gas tax. A lot of other taxes just go into a general fund. And if you think about what the world would be like if there were no roads, if there were no sewers, if there was no police force, if there was no health department, things would be very different than how they are now. Some people think, well, maybe private companies could build roads and maybe we could have private police forces and private fire departments. I mean, who knows? Theoretically that might work, but I think the model that is proven is that if there's no government, then life is really difficult. There are places in the world where there's no effective government, and I don't know any one of them that has a high GDP or, you know, a high quality of life for the people who live there. But the whole point of taxes, we don't want to pay more than we have to, of course, but it's the price of living in a civilized society that, you know, there's certain things that only the government can effectively administer, like passports or border security. And so we all have to chip in to make that possible. Let's skip over this. All right. So here's a Walmart receipt. I'm sure that everybody's seen Walmart receipts before where it specifically identifies at the bottom of the receipt how much you pay in taxes. One interesting thing is that in a lot of other countries they still pay taxes on the goods that they buy, but the tax price is built into what's advertised on the shelf. So when you see that there is a, I don't know, let's see, what's one of the things on here? Pampers for $24.94. God, kids are expensive. $24.94 for Pampers. That's the price before the 8.25% tax would be added on in this locality. It looks like this is in Texas, where their sales tax is a little bit higher, since in Texas they don't have some other taxes. But in most of the other parts of the world, the taxes that are applied on goods that are purchased is built into the price that's advertised on the shelf. And so they'll tell you the total, and it includes taxes, and below the total they'll break out how much of that total purchase price goes towards taxes, but it's not additive on top like it is here in the US. So, you know, the ways of estimating that can be a little bit different. Some people say that sales taxes are regressive. Has anybody heard that phrase before, regressive?
Yeah.
What does regressive mean?
It means that it affects the poorest people the most.
Right. So if you have someone who's earning $1 million per year and he's spending $50,000 a year on goods and services, then the amount it takes to buy things that you're going to live on is a very small fraction of the income. Whereas for a poor person who's spending every penny that they earn, the sales taxes are a larger share of their income. So although sales tax is a fixed percentage of the item that's being purchased, it's not necessarily affecting everyone equally. So the less you make, the bigger bite the sales tax is taking out of your purchasing power. Sales tax vary from state to state. Some places don't have any sales tax because they raise revenue in a different way. So Oregon, for example, has no sales tax. Montana, I think Delaware and New Hampshire don't have any sales tax. And then some states have really high sales tax, like California, Texas, Kansas. New York has high sales tax, and these are statewide taxes. Sometimes there can be local taxes as well, and we have that here in West Virginia, where the state tax is 6.37%, but then here in Huntington I know that they add an additional 1% on items that are purchased within the city limits, and so locality taxes are on top of this. I think what's sometimes a little bit interesting is when you live on a border area. You know, for instance, if you live on the border of Oregon and California, and you're thinking, I'm going to buy a TV, would you decide to buy the TV in Oregon or would you buy the TV in California? You know, if it's same store, you know, Walmart in either place, but in Oregon you don't have to pay the sales tax. You know, legally, you're supposed to pay the sales tax regardless of whether it's collected or not. And when you file an income tax return in West Virginia, they ask you, you know, what's the value of your magazine subscriptions? What's the value of any items you purchased online outside of the state that you haven't yet been taxed on? So you're supposed to report all of your purchases, but in practice, most people wouldn't bother reporting the additional sales tax they owe for items that are purchased out of state. Oh, I didn't even notice Louisiana. Look at this, 10%. Yeah, that's high. Now, one alternative to sales taxes that is being adopted in a lot of places outside of the United States is what's known as a value-added tax. And it's thought of as being a lot more fair than a sales tax, because in a sales tax, the entire burden of taxation falls onto the consumer. So although an item that's being produced is, you know, that production is benefiting the person who's generating the raw goods, the person who's transforming the raw goods into a usable material, the manufacturer who takes the material and turns it into a thing, and then the middleman or distributor who turns it from the producer and gets it into the stores. You know, all of those people along the way are benefiting from the production of the item, but it's only the consumer that ends up paying a tax in the end. And so to try and distribute the burden of taxation more evenly, value-added taxes have been developed as a way of taxing each step in the transaction. And at first it looks a little bit complicated, but I think once you're accustomed to understanding how it works, you'll see that it's a little bit more fair. And so if you just follow this step-by-step process, let's say that a farmer is growing cotton and sells the cotton to a textile maker and it's $1. If we have a 10% VAT, then that means that the farmer has to collect $1.10 from the textile maker. The farmer keeps $1 and gives the 10 cents to the government. You know, at the end of the year or the end of the quarter, they're reporting all of the sales that they've made during the period in question, and then they turn over 10% of that amount to the government. Now, in step 2, the textile maker bought the stuff for $1.10, and of that, the purchase price was $1 and the tax was 10 cents. And so in the back of the textiles maker mind, or accounting department, they know that they've previously paid 10% in taxes. And when they sell the item for $5, the textile that is, to the clothes maker, they have to collect $5.50 because it's going to be the $5, which is the sales price, plus the 50 cents in VAT. And so they're collecting $5.50, but they only have to give to the government 40 cents because they get a refund of the 10% that they paid before. Now that's why it's called a value-added tax, is you're only being taxed on the value that you add to the item. And so the value that was added was $4 because when you take something that cost $1 and you turn it into something that will sell for $5, you've added $4 of value to that material. And so you owe tax on 10% of the value that you added. And so it just so happens that when you keep the 10 cents that you'd previously paid and you turn over the 40 cents to the government, then that means that you've satisfied the tax burden, and it was only the increase in value that's getting taxed. So the same thing happens between step 2 and step 3. Let's say that the clothes maker buys the fabric, the sales price is $5, and of course they actually paid $5.50 with the tax, and so when they sell it for $12, the value that was added was $7 of value, and so they're going to have to pay 70 cents in taxes. And the way that that happens is that when they're selling it for $12, the tax that has to be collected is $1.20, so the total transaction price is $13.20. They keep 50 cents to reimburse from the previous step, and they pass along to the government 70 cents. And so then it's the same step, the same process in step 4. And if you add up all of the VAT that's collected, the value-added tax, when it went from $1 and the ending value was $20, then they had to pay the net value that was added was $19 from, well, I guess if you're growing the cotton, you're starting with 0 value. So the net increase in value was from 0 to 20. So the total VAT collected was 10% of that total value. So it seems complicated, but the advantage of this system is that it dramatically reduces the incentives for black market sales. And you maybe have heard of, like, in some places where cigarette taxes are really high, people will like fill their trunk with cigarettes and then drive into New York City, for example. If you go to Kentucky, cigarettes are really cheap. The tobacco tax in Kentucky and Virginia and North Carolina is much lower than a lot of the rest of the country. And so if you're being sneaky and you filled your trunk with cigarettes that had a low tax and then you drive somewhere into a high tax area, then you can like split the difference and you're cheating the government out of the excise tax that they have due. But a value-added tax like this reduces that incentive because every step of the process is paying the tax rather than just only the transaction to the consumer.
Yeah, and I remember when I was living in South Florida, they had these tobacco shops on Seminole Land. Oh
yeah, right. Yeah, and so why do people go to an Indian casino or an Indian land to buy cigarettes? It's because the taxes are lower, so the item itself costs less. Right. So value-added tax helps to avoid those sorts of shenanigans, and it's becoming common in a lot of Europe. I used to live, as I've mentioned before, I used to live in a country called the United Arab Emirates, and they used to have no taxes there, but they've recently introduced a 5% value-added tax, and I mean 5% is not so bad, but they looked at the data and they found that it's the easiest to manage and there's the least amount of abuse when it's value-added instead of a sales tax. Now earlier we talked about gas taxes, and you'll notice that there's a huge variability in gas taxes across the United States, and gas taxes, in theory, when you go to purchase fuel, there's a federal fuel tax and then a state fuel tax, and all of that money is supposed to go to supporting roadway construction and maintenance. And so, for example, in Pennsylvania, they have 58 cents per gallon compared to Kentucky, 26 cents per gallon. And I'm sure many of you have noticed that when you drive from West Virginia to Kentucky, immediately the fuel is a little bit cheaper. And it's because the gas tax in Kentucky is lower. And I always notice it when I go down to Clemson, South Carolina to work on the FE exam. I go down there several times per year to write questions for the FE, and I fly into Charlotte, which is in North Carolina, and where the fuel tax is 34 cents per gallon. And I'm driving the rental car, and as soon as I cross into South Carolina, instantly gas is so much cheaper because the fuel tax is nearly 20 cents per gallon less. So this is an example of something called an excise tax, and that's important terminology for you to be familiar with. An excise tax is levied on a certain item rather than broadly, like sales or value-added taxes. Cigarette taxes is another illustration of an excise tax. An excise tax is something where you're either trying to discourage people from doing it or where you're trying to raise a separate pot of revenue that can be used to maintain that particular thing. So in the case of cigarette taxes, it's partly to discourage people from smoking and also because smoking costs the government more money, because a lot of the people who smoke will end up on some sort of a public insurance program later in their life when they need a lot of medical assistance. So if you compare the cigarette taxes in New York, $4.35 per pack, compared to the cigarette taxes in Virginia, 30 cents per pack, you can see that there would be an enormous incentive for people to smuggle to try and beat that excise tax in New York. So there'd be less of an incentive for that sort of thing if there was a uniform tax across the entire United States, or if the tax was value added, because if it was value added, then the cigarette manufacturer would pay some of it, the retailer would pay some of it, the distributor would pay some of it, and those transactions would be harder to hide compared to just a single person who's moving them in a personal vehicle across state lines. So a value-added tax, that's kind of an illustration of how it helps to avoid abuse. So if you add up the average American and the excise taxes that they pay, and so these excise taxes can include special taxes on alcohol, fuel, special taxes on tobacco, as we've mentioned before. The excise taxes from state to state varies a lot. Here in West Virginia, we're kind of on the higher end of the scale for our exposure to excise taxes because of the state taxes that apply for alcohol, the fuel taxes kind of being in the middle, and so on. But a lot of people decide where they retire based on the tax burdens from state to state. You know, Florida, for instance, is known as a retirement haven, and it's not just because of their good weather, it's also because they have no income taxes in Florida. Their excise taxes are kind of in the middle or towards the lower end of the scale. Nevada is another one that doesn't have income tax, but you can see that they have really high excise taxes. And so Nevada is trying to make a lot of its revenue by taxing the people who come in for tourism. And so if they have high alcohol and tobacco taxes in Nevada, then they know that the tourists are going to pay a disproportionate share of the state revenue that has to be collected. Okay, so we've talked about what excise taxes are and how those are often applied on either non-necessities or on things where a separate pool of revenue wants to be collected, and how that varies from a sales tax, which is a broad fixed percentage rather than cents per gallon in the case of fuel or dollars per pack in the cases of tobacco. A sales tax is just a percentage of the total purchase price. Property taxes are different from either of these because property taxes are collected more at the local level rather than at the state or federal level. So excise taxes are often federal taxes, sales taxes are often state unless there's a small addition added at the local level. But property taxes here in Cabell County are collected are assessed by the Cabell County assessor, and then when you pay your property taxes, do you know who you make the check out to? Anybody paid property tax in Cabell County? Just me? Bunch of shirkers. You pay it out to the sheriff, oddly enough. The Sheriff Zirkle, I think his name is Sheriff Zirkle, he's the one that collects the property taxes in Cabell County. We'll look at where that money goes. The vast majority of property taxes in most places goes to fund education. That's kind of a traditional way that local school districts have raised money, is through the property taxes that are collected. Now, unlike income taxes and sales tax, property taxes are fixed regardless of whether you make a lot of money. So, you know, income tax, you pay more if you're earning more. Property tax is based on the value of the land or the value of the vehicle. And so it doesn't matter if you have a high salary or a low salary, you still have to pay the same amount of property tax. And it doesn't matter necessarily what you're doing with the property, although how you're using it can affect its value. But some people have, you know, for instance, a really big property that they use as a hunting property, maybe, you know, several hundred acres that they use just for hunting, and that can be really expensive if you have to pay the taxes on that entire parcel of land. I guess when it comes to property taxes, there's definitely incentive to own less, you know, to take the minimal approach, because the less you own, the less expensive it's going to be. Now, income taxes are based on your earnings minus deductions. And so one type of deduction you've already learned about is the deduction that businesses can take for the depreciation in the value of their equipment. So that's one deduction, but there are other deductions as well, such as a child tax credit, the standard deduction, which you get just for being alive. It's a certain amount of your income you can earn tax-free, called the standard deduction. And those income taxes go into a general fund that unfortunately you don't get to choose how it's used. It would be kind of interesting if you got to say, well, I want my taxes to go towards roads and schools, but not necessarily towards the Coast Guard, because I hate those guys, or whatever. If you could choose where your money got spent, then I think it would be very different. All right, so I have an in-class exercise where we're going to focus in on the property taxes. And so we don't have loads of time. We've got about 25 minutes. Let's do it in this order. I'm going to give you the in-class exercise paper, and let's start with the property tax, which is on the back side of the paper, and work through that. And then when we're finished with property tax, we'll go over the solution together, and then we'll go to the front side of the page, which is the excise tax. I feel like the excise tax problem is probably a little bit less important than the property tax problem, which begins on the back. So we'll do the important thing first. Now, I give you a website that you need to go to look up the tax rates. So it's also here on the screen, but okay, so in the first bullet point it says the home is in a rural area and it's owner occupied. So owner occupied is class 2. The thing is that if it's not owner occupied, then you have to pay more in certain places, and so that means the tax rate 1.3712. So the handout says that the appraised value is $200,000. So the overall property tax that's going to be due is, we first of all have to find the assessed value from the appraised value. So it's $200,000, which is the appraised value. So 200,000 times 0.60. So now once you multiply it by 60%, that gives you the assessed value. And then we multiply it by 1.3746 divided by 100. So that means on an annual basis, the tax that's due is $1649.52. And they actually have you pay it in halves. There's the half-year tax payment. You can pay it all at once and they give you a very small discount. But more specifically, the sheriff collects the money in 2 equal payments. And every year they can, in theory, do a reappraisal of your property. If you make improvements like you add an additional bedroom, or remodel the house so now it's worth more, then you have to pay more. So owning an expensive house, you're paying in lots of different ways. If you own an expensive house, it maybe is going to take you longer to pay it off, so you'll have more in interest charges in addition to the higher initial purchase price. You're paying more in interest, and then you also have to pay more in property taxes each year. There's a lot of arguments in favor of just owning enough house, not owning a lot of house. Okay, so any questions on how we got to 1649.52? The next part of the bullet point says, what if it's located in the city of Huntington instead of in a rural area? The same $200,000 property now is in Huntington and it's rented out, so it's class 4. So if we go to the city of Huntington, their class 4 tax rate is 3.3824. So we'll have still the same assessed value, but it's just that the tax rate changes. So now we're multiplying it by 3.3892, which means that the tax should be $4,067.04. So that's a pretty big increase from less than $2,000 to more than $4,000. How can Huntington get away with that? Why are people willing to pay higher taxes in Huntington rather than in rural areas? If you look, the rural area class 2, 1.37, the Huntington class 2, 1.69. Why do you suppose Huntington charges more?
There's so many more jobs in Huntington, it's just easier to drive.
Okay, so you're looking at it from the perspective of they can get away with it because it's more convenient to where a lot of people are going. So it's maybe a supply and demand type issue, and I think there's some truth to that. What about looking at it from the other direction? Why do they need to charge more than the rural areas?
They have like a fire department and a police department.
Right, yeah, they have a professional fire department rather than a volunteer fire department, and they have maybe faster response times. You know, like if you live out in the country like I do, you call the police and they'll be there when they're there. You know, like you're down a long road, it's going to take a while for them to arrive. So, yeah, the city of Huntington also has a sewer system, whereas where I live doesn't have a sewer system. We don't have gas. City of Huntington has gas. Now, it's not the city that's providing gas, it's a private utility, but still the city had to put some of the infrastructure into place so that those utilities can exist. And so those are some of the justifications they use for having higher property tax. Now, how they can get away with charging more for rentals, I don't know about that. You know, I guess it's just because the renter, the little guy, doesn't have as much say in the matter. So that's just historically the way they've done things, is it's a discount if it's owner occupied. It's like taxation without representation, I suppose. All right, any questions on how we did the class 4 property tax? Now it says how much is going to go to support of the $4,067.04. Has anybody calculated yet how much will go to the library? Because at the bottom of the page, let's see, where was that? Oh, they may have moved it. Yeah, it used to be at the bottom of the page. They would tell you the fraction of how.
Right in the middle of that red link right there.
Is this link?
But
Oh, where it goes.
Library, so.
Okay, proceed to tax estimator. All right, let's try this. Who needs this calculator? Us. Let's give it a try. If the appraised value is 200,000, the assessed value, yep, it just multiplies by 60%. All right. So assessed value, 120,000. See, in the past they were showing all of the different places that the money can go.
Was he under school excess?
No, it was a separate line item previously, and what it worked out, I mean, just in case you're curious, the fraction that the libraries got was 0.0127 of the taxes, and so it was basically, if you were paying $4,067 for taxes, about $50 would go towards the library. But I don't know, they've changed that. I'm going to call and complain to the assessor, because I know they're still giving the money to the library, they're just not breaking it out any longer. They must have combined categories for purposes of display. Okay, so I suggested that we should start with the property tax and then move to the excise tax. Now this next part has to do with the gas tax. And so, you know, a lot of people have complained that the gas tax that's being collected isn't enough to actually perform the maintenance that needs to be done. So the Department of Highways is getting pulled in two different directions. On the one hand, they have people calling and complaining about the quality of the roads, that the paving isn't even, that there's potholes everywhere, there's slips and landslides, and so the Department of Highways has a big job in terms of maintenance, but then the other issue is that the gas tax hasn't increased. You know that the cost of materials is always going up, the cost of labor is always going up, but the gas tax in terms of the number of cents per gallon that's collected has been constant for decades. And so the state isn't collecting more fuel tax revenue, it's just that all of their expenses are going up. So what I'd like us to do is take a look at what was the budget back in 2016. I've looked for more recent budgets than that, and it wasn't immediately clear where it was, but I know where the 2016 budget is. So if we go to that website, let's figure out two different ways. How are you going to collect enough money to meet that budget requirement? What if, on the one hand, we just did a per vehicle registration charge, and then on the other hand, how much would the gas tax need to be to collect enough revenue to fully fund the Division of Highways? So let me bring up the website on my screen. How much they paid on transportation in 2016. It says here that these numbers are in thousands. So the column on the far right is how much the transportation department had as their budget. So that's not 1.2 million, that's 1.2 billion, since all of these numbers are in thousands. So if we were going to collect $1.2 billion, the first question asks, what if we did it on a per vehicle flat fee? And there are some states that do that. I used to live in Kansas when I was in high school, and registering a car in Kansas was really, really expensive, even back then. I think here in West Virginia, is our registration like $60 a year? They raised it recently, but it's still relatively cheap. It's less than $100 a year. What would it be, what would it need to be if we were collecting $1.262 billion on the basis of 700,000 registered vehicles? So that means that it's going to be $1,803.31 per vehicle. And that's quite a lot higher than the registration tax is now. People would really flip out if you raised the tax. I think now it's $60 per year. If you raised it from $60 to $1,800, there would be a revolt. That's why they don't do it. So how are we going to get the revenue? Well, if we said that there's 1,844,000 people, and the average person is consuming 458 gallons of fuel each year, then that means that on an annual basis within the state, 844,552,000 gallons of fuel are being consumed. And so you have to collect the $1.2 billion on the basis of the fuel that's consumed, 844 552,000 gallons. That means that the tax would have to be $1.49 per gallon. And again, just imagine how upset people would be. Right now, gas is about $2.50 a gallon, roughly. So if gas went from $2.50 a gallon to $4 a gallon, people would really feel it. That would really take a big bite out of a lot of people's paychecks. But the fact is that this is the money that's already being spent on roads. And so right now, other parts of the taxes are subsidizing the roads. And so think about who uses the roads and who benefits from them. We don't all benefit equally from the roads. There are trucking companies that all of the profits that they enjoy arise out of the availability of roads. There are like retail, or Walmart or grocery stores. They get a lot of value out of the roads, more than maybe the average person. We all use the roads, but how much of the profit that you make comes from the roads? And so there's been a lot of debate over the years of finding an equitable way to recover transportation costs. One other thing I wanted to show you was the income tax brackets that apply for 2019. This semester, the semester is a week less than it used to be. I don't know if you're aware, but during previous years, a Tuesday, Thursday class would have 30 class meetings, but we only get to have 28 class meetings this week because they reduced the length of the semester. So I'm having to kind of truncate some of the things that I'd ordinarily go over when it comes to income taxes. So we're almost out of time, but I wanted to show you how this works and correct a misconception that I had before I started paying income taxes. So what this is showing is that you pay a 10% rate on every dollar you earn. Let's say that you're unmarried. So you pay 10% on everything up till $9,700. And then the amount above $9,700 you pay 12% on. The amount above $39,000 you pay 22% on. So let's say a person is earning $100,000. So since you're earning $100,000, that doesn't mean that all of your income is taxed at 24%. What it means is that each additional dollar beyond $84,200 is taxed at 24%. So all of the income below that is taxed at the same rate as someone whose income is at that rate. So, my impression was that you wouldn't want to get paid $84,200. You'd want to get paid $84,199, and then therefore you'd be in some lower tax bracket. But it doesn't work like that. It's just each additional dollar gets taxed at the higher tax rate. And so it's sort of like the first block of money you earn is taxed at a lower rate than the next block of money you earn. And that's what they mean by progressive, is that the rates are going up for each increment of additional money that's being earned. So we won't have the time to go through a full 1040. We're out of time. But let me just refresh your memory about these announcements. You don't have any more homework to concern yourself with, but you should begin preparing for the exam, because a week from today we'll be about halfway through the test. If you have any questions as you're studying, feel free to stop by my office or send me an email, and I will see you next Thursday for the test.